I have studied economic cycles for decades, and I can tell you with high confidence that we are heading into a period of stagflation that will be more severe and longer lasting than what we experienced in the 1970s. This is not a cyclical downturn that will correct itself naturally. This is a structural problem created by forces that have been building for years and are now converging in ways that leave policymakers with no good options. Understanding why this is different from past cycles is critical for anyone who wants to protect their wealth and navigate what is coming. Stagflation is the combination of stagnant economic growth and persistent inflation occurring simultaneously. This violates the traditional relationship where growth and inflation move together. In normal cycles, when the economy grows, demand increases and inflation rises. When the economy slows, demand falls and inflation decreases. Central banks use this relationship to manage the economy, raising rates to cool inflation during booms and cutting rates to stimulate growth during recessions. Stagflation breaks this mechanism because it presents contradictory problems at the same time. The 1970s provide the historical template. Oil shocks, productivity slowdowns, and loose monetary policy combined to create years where inflation stayed elevated while growth remained weak. Unemployment rose alongside prices, which was not supposed to happen according to prevailing economic theory. The period was miserable for most Americans. Real wages declined, savings were eroded by inflation, and traditional portfolio allocations of stocks and bonds both performed poorly. It took brutal medicine to break the cycle. Paul Volcker raised interest rates above 15% in the early 1980s, deliberately triggering a severe recession to crush inflation. This worked, but it was only possible because the government's debt burden was manageable and the political will existed to endure short-term pain for long-term stability. Today, we face similar inflationary pressures, but with critical differences that make the 1970s playbook unavailable. The first difference is debt. In 1980, U.S. government debt was roughly 35% of GDP. Today, it exceeds 130%. This means the Volcker solution of raising rates to 20% is mathematically impossible. Interest payments on $35 trillion of debt at high rates would consume the entire federal budget. The government cannot afford to break inflation through severe monetary tightening because doing so would trigger sovereign debt crisis before inflation was controlled. The second difference is demographics. The 1970s featured a young, growing workforce. The baby boom generation was entering peak productive years. Today, that same generation is retiring en masse, which reduces the ratio of workers to dependents and strains entitlement systems. An aging population tends to lower productivity growth and increase fiscal pressure, both of which contribute to stagflationary dynamics. You cannot grow your way out of stagflation when your workforce is shrinking relative to your dependent population. The third difference is deglobalization. For 4 decades after 1980, globalization provided a powerful deflationary force. Manufacturing moved to low-cost countries, supply chains became globally integrated, and goods became cheaper for consumers in developed economies. This dynamic is reversing. Geopolitical tensions, pandemic disruptions, and strategic competition are driving reshoring and friendshoring of production. This makes goods more expensive and reduces the efficiency gains that kept inflation low despite aggressive monetary expansion. The fourth difference is energy transition costs. The 1970s oil shocks were temporary supply disruptions that eventually resolved. Today, the global economy is attempting a transition away from fossil fuels toward renewable energy, while simultaneously facing underinvestment in traditional energy infrastructure. This creates persistent upward pressure on energy costs during the transition period, which feeds into every sector of the economy. Unlike the 1970s, this is not a shock that can be solved by increasing oil production. It is a structural shift that will take decades and will be inherently inflationary. These 4 factors, high debt, aging demographics, deglobalization, and energy transition, create a fundamentally different environment than the 1970s. The tools that worked then are unavailable now. Central banks cannot raise rates high enough to break inflation without triggering financial crisis. Fiscal policy cannot stimulate growth without worsening inflation and debt dynamics. The policy space has narrowed to the point where every action trades one problem for another without solving either. The Federal Reserve is trapped in an impossible position. If it raises rates aggressively to control inflation, it risks recession, financial instability, and a government debt crisis as interest costs explode. If it keeps rates low or cuts them to support growth, inflation persists or accelerates, eroding purchasing power and destabilizing expectations. There is no setting where both inflation and growth are satisfactory. This is the essence of stagflation and why it is so difficult to escape once established. History shows that stagflation is particularly destructive to traditional portfolio strategies. In the 1970s, stocks performed poorly in inflation-adjusted terms because corporate earnings were squeezed between rising input costs and weak demand. Bonds were catastrophic because inflation eroded the real value of fixed payments. A standard 60-40 stock-bond portfolio lost significant purchasing power over the decade. Real estate performed better, but with high volatility and regional variation. Commodities and gold were the clear winners, but most investors were not positioned in these assets. Today, the same dynamics will apply, but potentially more severely. Stock valuations are higher now than in the 1970s, which means there is more room to fall when earnings disappoint and multiples compress. Bond yields are lower, which means less cushion against inflation and greater sensitivity to rate increases. The traditional safe haven of government bonds becomes a trap in stagflation because fixed income loses value in real terms while providing no growth. Understanding which assets outperform in stagflation is critical. Commodities benefit because they are real assets with tangible value that maintains purchasing power when currency depreciates. Energy, industrial metals, and agricultural products all tend to perform well. Gold and silver serve as monetary hedges when confidence in fiat currency declines. Real estate can preserve value if it generates income that adjusts with inflation, though leverage becomes dangerous if rates rise. Equities in companies with pricing power, low debt, and essential products or services can outperform, but most stocks struggle. The distinction between nominal and real returns becomes critical in stagflation. A stock that rises 10% might sound good, but if inflation runs at 8%, your real gain is only 2%. Meanwhile, holding cash guaranteed a real loss. This psychological trap fools many investors into thinking they are doing well when they are actually falling behind. You must think in real terms, not nominal terms, to understand whether wealth is being preserved or eroded. For individuals and families, stagflation presents specific challenges. For workers, wages lag inflation, meaning declining real income despite stable employment. The middle class gets squeezed hardest, lacking assets to hedge inflation while depending primarily on wages. For retirees, stagflation is particularly brutal. Fixed income loses purchasing power rapidly. Social Security adjusts with a lag and often misses real cost increases in healthcare and essentials. Retirees cannot work more to offset losses, locked into declining real income with limited options. For younger workers, housing becomes less affordable as rates rise while prices stay elevated. Student debt burdens increase if wages do not keep pace. Career advancement slows in low-growth environments. The generational wealth gap will accelerate during stagflation. Policy responses will make this worse before it gets better. Governments will face pressure to provide relief through subsidies, price controls, and expanded benefits. These interventions treat symptoms without addressing causes and often create new distortions. Price controls lead to shortages. Subsidies require more borrowing, which adds to inflation. Expanded benefits increase long-term fiscal burdens. Each intervention designed to ease pain in the short term extends the stagflationary period and makes the eventual resolution more painful. Politically, stagflation is toxic. Voters experiencing declining living standards demand action. Politicians promise solutions that sound appealing but do not work economically. Populism rises on both left and right as people seek someone to blame for their deteriorating circumstances. Policy becomes increasingly erratic as administrations swing between contradictory approaches. This instability further undermines business investment and economic confidence, which worsens the stagnation component of stagflation. International dynamics compound the domestic problem. In a deglobalizing world, economic blocs compete rather than cooperate. Trade wars reduce efficiency and increase costs. Currency tensions create instability as countries try to export their inflation to others. Capital flows become unpredictable as investors search for relative safety in an environment where all major economies face similar challenges. The synchronized nature of global stagflation means there are fewer safe havens than in previous crises. The path out of stagflation historically requires one of two things. Either productivity growth accelerates dramatically, which increases real output and makes inflation manageable, or monetary policy crushes inflation through severe recession that resets expectations and clears imbalances. The first path requires technological breakthroughs or structural reforms that boost efficiency. The second path requires political will to endure significant pain for long-term gain. Neither seems likely in the current environment. Artificial intelligence and other technologies offer potential for productivity gains, but the benefits take years to materialize and are unevenly distributed. Regulatory barriers, infrastructure constraints, and workforce transitions slow adoption. Even if new technologies eventually boost productivity, there will be a lag before this translates into higher real growth and lower inflation. Stagflation could persist for a decade or more before technological solutions provide relief. The alternative of intentionally triggering severe recession to break inflation is politically unthinkable given current debt levels. A deep recession would cause unemployment to spike, tax revenues to collapse, and automatic stabilizers like unemployment benefits to surge. The deficit would explode at precisely the moment when bond markets are already stressed by high inflation. The risk of sovereign debt crisis becomes unacceptable. No government will voluntarily choose this path, which means stagflation persists by default. For investors, the strategic response requires accepting higher volatility and lower real returns than the past 4 decades delivered. The era of easy gains from a balanced portfolio is over. Active management, tactical allocation, and real asset exposure become essential. Diversification across asset classes and geographies remains important, but the correlations will differ from what worked in the past. What preserved wealth in the 1970s provides the template. Commodities, real assets, companies with pricing power and precious metals, cash becomes a trap in stagflation. The purchasing power erosion from inflation exceeds any yield from savings accounts or short-term bonds. Yet maintaining some liquidity is necessary for opportunistic deployment when dislocations create value. The balance between protecting purchasing power and maintaining flexibility is difficult but necessary. Absolute rules do not work. Context and timing matter more in stagflation than in other environments. The psychological challenge is as important as the strategic challenge. Stagflation tests patience and discipline. Watching portfolios stagnate or decline in nominal terms while expenses rise is demoralizing. The temptation to make emotional decisions, chase performance, or abandon strategy increases. Yet these mistakes are precisely what destroys wealth during difficult periods. Those who maintain discipline and stick to sound principles will emerge in better shape than those who panic and trade reactively. Looking forward, the combination of high debt, adverse demographics, deglobalization, and energy transition costs creates conditions where stagflation becomes the default outcome, absent major policy shifts or technological breakthroughs. Neither seems imminent. This means the next 5 to 10 years will likely feature below-trend growth alongside above-trend inflation. Traditional portfolio approaches will underperform. Policy will remain erratic as leaders struggle with tools that no longer work. Political and social tensions will rise as living standards stagnate or decline. This is not a prediction of collapse or catastrophe. It is a forecast of grinding difficulty, where progress slows, options narrow, and the path forward requires more effort for less reward than recent generations experienced. Understanding this reality enables better preparation than clinging to the hope that past trends will resume. The 1970s taught a generation of investors that conventional wisdom can be wrong for extended periods. The coming stagflation will teach the same lesson again to those who believe the past decade's experience represents a permanent normal. The question is not whether stagflation arrives, but whether you are positioned for it when it does. Those who adapt their strategies, adjust their expectations, and allocate appropriately will preserve and potentially grow real wealth. Those who cling to outdated approaches and wait for normality to return will discover that this time normality has changed. And by the time that realization becomes widespread, the opportunity to reposition will have passed.